Welcome to The Explainer. Today we're going to talk about something that sounds complicated, but is actually a genuine superpower: understanding financial reports. These aren't just for accountants. They're the story a company tells about itself, and knowing how to read that story, well, that's everything. Let's get into it.
So it really all boils down to this one question, right? You see a company, it looks interesting, maybe you want to invest, maybe you want to work there. But how do you really know if it's a solid bet? You need to be able to trust the information it's giving you.
And you know what? That big question of trust is exactly what financial reporting is designed to solve. The whole point is to give people like you and me a reliable, consistent picture so we can make smart decisions with our money and our time.
And the key word here, the absolute most important word, is useful. This whole system isn't about making complicated rules just for the sake of it. It's built from the ground up to serve the people who are actually putting capital on the line. Investors, lenders, you name it. It's all about giving them information that helps them make better calls.
Okay, so how does a company actually tell its financial story? Well, it uses a whole set of official reports, but we're going to focus on the two big ones: the income statement and the balance sheet.
Here's the easiest way to think about these two. The income statement, that's like a movie. It shows you the company's performance over a stretch of time, like a quarter or a whole year. The balance sheet, on the other hand, is a photograph. It's just a snapshot of what the company owns and what it owes on one single day. So one tells you about the action, and the other tells you about its position at a moment in time.
But hold on. For any of this to be trustworthy, everyone has to be playing by the same rules, right? We need a shared language so that when one company says profit, it means the exact same thing as when another company says it. And that language is built on a set of common standards.
Here in the United States, that language is called U.S. GAAP. You can think of it as the official rulebook. It's the grammar and the dictionary that all financial professionals have to use. And since 2009, an organization called the FASB has put all these rules into one single place: the Accounting Standards Codification, making it a real one-stop shop for all the official guidance.
Now, this rulebook didn't just appear out of nowhere. It's evolved a lot over the years. We started with these part-time committees way back when, and eventually moved to what we have today, the Financial Accounting Standards Board, or FASB for short. Since 1973, this has been an independent, full-time organization in charge of setting the standards, which was a huge step toward making the whole process more rigorous and objective. So the FASB doesn't just make up rules on a whim. Everything they create is based on what's called a conceptual framework. It's kind of like the Constitution for financial reporting, and it all comes back to that one goal we talked about: making sure the information is genuinely useful for making decisions.
So for information to actually be useful, it has to have two fundamental qualities. First, it's got to be relevant. Does it actually help you predict the future or confirm something you thought in the past? Second, it has to be a faithful representation. Is the story true? Is it complete, neutral, and not full of errors? And here's the thing: you absolutely need both. Relevant info that isn't true is worthless, and true info that isn't relevant, also worthless.
Okay, that's enough theory. Let's see how these rules actually play out in the real world. We'll take one of the most basic but crucial questions in business. When do you actually get to count the money from a sale? And believe me, it's not always as simple as when the cash shows up. The answer, according to US GAAP, is found in a very specific 5-step model. And this isn't just a friendly suggestion, it's a mandatory process every single company has to follow. It's all about making sure that companies recognize revenue in a consistent way, and frankly, to stop them from booking sales before they've really earned the money.
This model forces companies to be super precise. So instead of just booking all the money from a big contract on day one, they have to break it down. They have to identify every single distinct promise they made to the customer. Those are the performance obligations. A great example is your phone contract. The phone itself is one promise, but the monthly service is a totally separate promise. The phone company can only count the revenue for the service month by month as they provide it, not all at once when you sign up. This rule had a huge impact on industries like software and telecom.
And it all comes back to this one fundamental idea, a principle accountants call conservatism. It's basically the old saying, don't count your chickens before they hatch. You can only count the revenue when the job is actually done and you've earned it. So the rules help us count things correctly, but they also help us do something else that's incredibly important. They help us separate a company's core, repeatable business, the signal, from all the one-off events that can just be distracting noise.
This is super critical when a company makes a big strategic change, like selling off a whole division or pulling out of a country entirely. The profit or loss from that part of the business they got rid of gets pulled out of the main results. It's reported separately in a line item called discontinued operations.
And this is so important for getting a clear picture. I mean, imagine a company's main business has a terrible year, but they sell off a division for a huge one-time profit. Without this rule, their final net income might look amazing, totally hiding the problems in their core operations. By separating it out, you, the investor, get to see exactly how the part of the business that's actually sticking around is performing.
So let's bring this all home. Let's circle back to where we started and see how this all empowers you. We started with that basic question of trust. Now you know where to find the company's story, in its financial statements. You know that story is written with a specific grammar, US GAAP, that makes it reliable. And you've seen how specific rules, like the ones for revenue, are designed to give you a clearer, more honest picture.
And that's really the main takeaway here. A financial report isn't just a jumble of numbers on a spreadsheet. It's a carefully constructed narrative. And knowing the rules of that narrative, knowing the grammar, is the key that lets you read between the lines and understand what's really going on.
Thanks for joining this explainer. The point is, you don't need to be a CPA to make smart decisions. Just by understanding the logic and the framework behind the numbers, you are so much better equipped to read any company's story and decide for yourself if it's a bet worth taking.